So what's asset allocation? Asset allocation is how you put things in your buckets or your investment baskets. Grandma was right. Don't put all your eggs in one basket. And asset allocation is that process.
And it's your groceries.
Yeah, it's right.
Is it your groceries or your shopping cart? It's your groceries.
Right. Those are right. Those assets are your groceries. So asset allocation is important for 3 reasons. Number one, research has shown that most of the returns come from being in the right asset class, not picking the individual stocks and bonds. Why do I like that? Because I don't want to spend time picking individual stocks and bonds.
He needs a drink.
It's very easy just to set my asset classes, and that way I can do the important things in life, like hanging out with my wife and playing with my grandkids and doing all these other things too. Number 2, as you select your asset allocation or your baskets, you're selecting your risk level for your portfolio. So in setting your asset allocation, you're setting your risk level. And number 3, asset allocation helps you determine your diversification. Again, that's one of the principles of successful investing, to be diversified. So the question is, what's the process of determining your asset allocation? So asset allocation is a 3-step process. Number 1, set your initial bonds and cash allocation equal to your age in bonds. So this is an old method that's probably been used for 60 years. So if you're 70 years old, you'll have 70% in bonds. What's the logic behind that? The closer you are needing your retirement money, the less risk you should take. So I'm 70, so this says I should have almost all of mine in bonds.
But we don't.
And again, Iris is 24. She'll have very little in bonds. So that's our first step. Second, we take a risk tolerance test. And
which we just did.
And then number 3, based on that risk tolerance test, you'll do our preferred asset classes within your major asset
And that's what we're going to do right now.
That's what we're going to do right now. So because Metzley is moderate, so what's the change for moderate?
No change.
She's actually the easiest one because it's your age in bonds.
So I want to show you that if you're aggressive, listen, because this could be on the quiz number 5. So listen to this. If you're aggressive, you're going to add 10% to bonds to your subtract. Sorry. So if Metzley were aggressive, she would subtract 10 from her bonds. So if she's 32, she would only do 22 in bonds, and
then add 10% to
add 10% to stocks. So she'd do more in stocks. But if she were very conservative, then she would add 20 to her 32. So then she'd be 52 into bonds and only 48 into stocks.
Okay.
Or minus 40.
Right.
So it'd be 48 minus 2.
So I add the percentage to my age.
Right. So let's come down here.
But because you're moderate, you don't do anything.
So you're
But
good.
if you were conservative, you would add 10 here and subtract 10 here. If you're very aggressive, you would subtract 20 here and add 20 here. So we're going to give you an example on the quiz of someone, and we're going to give their age and what they're invested in, and then you're going to decide whether they're moderate or they're conservative or whether they're aggressive or whatever, according to what they've invested in and their age.
So notice Metzley was moderate, so there's really no adjustment. So she has 32% bonds and 68% stocks that she needs to allocate. So let's come down a little bit farther.
So everybody, remember you put your stuff in the green. See the green up there? That's where you're going to add your information. So you're going to put in your age now and how old you want to be at retirement. Those are the 2 things you need to put in.
Okay, let's come down a little bit farther. Now we're going to go to so start 1, age in bonds. Step 2, what's the recommended allocation? Step 3, what's your overall bond and stock allocations? We've done this.
Where are you
now
at?
Step 4. So now Metzley's going to have to determine how is she going to allocate her bonds. So she has 32%. How are you going to allocate that between short-term bonds and long-term bonds?
So you're going to do the 32% here and the 58% here. So everybody these 2 numbers have to add up to 32.
Right, so this column.
And these 2 numbers have to add up to 65.
Add up to 58. Right here.
58, sorry, 58, 32
Okay.
and 58.
So 32%, you can just do half and half if you want. Notice as soon as you get that allocation there, this goes away. Now, at retirement, you're going to have
58.
58.
So those
How are you
two
gonna
have to divide up into 58. Or 3. There's 3 things. You could divide all 3 of them if you wanted.
Yeah, just use I'd recommend you just use the first 2.
Oh, I guess not.
Yeah, just because I don't have any data on performance of
Oh, okay.
bank accounts. Okay. Okay.
Okay, so everybody did that?
Does that make sense?
Right.
Yeah.
Right. So now what she's done, she's taken her bond allocation.
So this is your bond allocation.
So
this is your accumulation stage, and this is your retirement stage.
accumulation or your current stage right now.
And it doesn't matter how much I invested?
Right. So right now we're just working on percentages.
Oh, okay.
So we're working on asset allocation targets. And it might take you a couple of years to get to your target. But this is where we are now. And now what she has to do, our equities, this is a lot harder. So what we've done is we've given you some historical information. This is returns, geometric returns over the last 10 years. Here's 25 years, here's 50 years, here's 95 years. So what we're trying to do is, what are some lessons we can take from this? So again, over the last 10 years, what was the highest performing asset class in equities? Yeah, large cap. What was the standard deviation? 15.1. Let's look over 25 years. What was the highest performing? Actually, it was small cap. But which one was the lowest risk? Again, over these 5 here.
Large
Cap. Let's look at the difference between small cap and large cap over 50 years. Which one had the lowest risk? And this is standard deviation.
The lowest risk?
Large. These are bonds.
Oh, so don't use those.
Yeah, so
just these 2.
15%. And over 95 years, lowest risk.
18%.
So what have we noticed about large cap? It's the least volatile, the least risky of all of the equity asset classes. We don't have 50 years of data for international or REITs or large cap. So what do we recommend from this view of graphs? We recommend that you have at least half or more of your portfolio in large cap. Why? Because it's the least risky of any of the equity.
And it's the highest return.
Yeah, sometimes it is.
Mostly the highest return and the least risky.
Right. Yeah, it's not always, but sometimes it is. Like this last 2 years, it's been the highest return. So let's go back up here. We're going to look at your equity allocations right here. So let's start. So what we recommend is at least half or more of your portfolio should be in large cap, just because it's the least risky.
Okay, so you're going to divide 68%. So you have 68% for this one. So you have to do.
So how would you like? What would you like to put in large cap? Least risky?
So he
48,
said
okay.
he said to put at least half.
Yeah, that's good.
Okay, that's good.
Okay, now you have 20% remaining. Do you like small cap? Small cap is higher risk, but higher return sometimes. Okay, what would you like to put it? You got 20% remaining? So again, we recommend you've got 42% in retirement.
Should it be more?
No, you have 42% to allocate.
In total, right?
So I'd probably take at least half of that and put it in large cap. Okay?
20, yeah, you have
And then you've got another 12%. You can do 6 and 6, like that. Okay. So what Metzley has just now done is she's come up with her asset allocation. Not only for her current allocation, but her retirement asset allocation. I'm just going to show them. Notice we've got a little summary sheet right now. So this is Metzley's asset allocation. So would you be interested to see how her asset allocation would have done over time? Would you be interested to see how it's done over the last 10 years or 25? Yes. So notice where that 50 is?
the 50 right
That's
here.
a drop-down box. Metzley, why don't you change that to
Sorry.
25?
You do it. 25.
So here's what we've done is these are the actual returns over the time period over the last 25 years. So here's the return for short term, here's the long term, and here's the standard deviation.
That's how much you would have made each year.
So
for
based
20
on this allocation,
Well,
what would you,
over the last 25 years, this is the average.
if you would have used, if the results going forward were exactly
Your-
the same as the
your
last
expected
25
annual
years.
return
So her
before
return would have been
was
6.5, about 6.4%,
and
and in retirement about
during
5.2.
retirement 5.2.
How about
This
the
is
last 10 years?
Sorry, you do.
Oh, her return would have been
7 and 5.
7.7 and 5.5 return. How about last 1 year? Or 5 years. Let's do 5 years.
Oh.
5 years, the return would have been 9.8 and 6.4. But do you see what we're doing? We're taking
9.8.
Metzley's asset allocation.
Brian, it says 7.
Right,
Oh, we're looking over here.
right here. So
I
this
didn't
is
know that.
this is the calculated, and this is our recommended.
Oh, this is the
So
recommended. This is
why
the calculated.
why do we have a difference between our recommended and our calculated? Is because some years it's going to be weird. So for example, this year with large cap,
Go up to 1.
you're up 25%. So what we'd recommend.
She did it over 1, it would have been 17 to 12. See, it was good last
How about if we go 50? Let's say if we go 50. Now you're, again, 9.5. How about if you do 95? Again. So what do we recommend
86.4.
Metzley do?
7 and 6.
Probably 6.5 or 7. I'd probably do 7% and 6%.
Like right here.
And so notice, come down here.
It says 7 and
Again, my
6.4.
expected annual return for investment is, so
the same.
7%. And I'd probably do 7% and 6.5. You can actually adjust
Yeah.
that.
Okay.
So now what has
you're gonna-
Metzley done?
Okay.
She has come up, she's done a risk tolerance test. She's found that she's moderate. She's actually calculated her allocation
Save
between stocks,
this
bonds, and cash.
And attach it to your
Then she's come up with her individual
just like we did before.
asset classes. And then she's come up with what's her expected return for her portfolio going forward. And her current allocation, she's expecting roughly 7% and about 6.5 in retirement.
So you guys will save this thing on the blue, and then attach it to your investment plan.
Yeah, so-
it'll be an exhibit 1.
So let's,
Is there a way to like play with the numbers
Yes.
that we did prior so we can
Yep.
get a higher return?
yeah, so I'm not worried about a higher return.
Oh, okay.
What I don't want you to do is come and put something unreasonable like I want 10% return. Yeah. So what this is giving you a kind of a
Just an idea.
general guidelines. So for example, this
Of what
last
you
year
can
was
expect.
wonderful because large cap was up 25%, and we have a good percent, our good percentage in large cap. But this is not an expected thing. So our estimate
Not normal.
yeah. Again, I think having a return, expecting a return of somewhere between 6 and 7% currently, and somewhere between 5 and 6% in retirement, I think those are good estimates for us.
And then when you get higher, you can be happy.
Yeah, when you get higher, let's talk about what we've done today. First thing we did is we took a risk tolerance test. And the purpose of the risk tolerance test is to see how much risk you're able to handle. Realize our risk, they're general categories, not absolute numbers. Number 2, then from that risk tolerance test, we actually made some adjustments. So the rule of thumb for most investors for the last 70 years is your age in bonds. And so what we've done is we've made some adjustments based on whether you are aggressive or very aggressive or moderate. If you're moderate, the good news is that it's your age in bonds. Realize you can make some adjustments. You're right on, Metzley's kind of on the border. If she feels more comfortable in being a little bit more aggressive, that's okay.
Yeah.
It's what you're comfortable with.
So if you went to a like Charles Schwab or something and you showed them your investment plan, they'd be like, whoa, this person knows what they're doing. And then they'll be able to use your investment plan to invest and help you
Yeah.
invest in things that you would be
Yeah.
risk tolerant of.
Yeah, in our case too is they're not going to be interested in you when you're starting off. They're probably not going to be interested until you have $500,000 to $1 million. You can build your portfolio yourself. You don't need help.
Right.
But as you get later on, you can probably bring in more help as
Okay.
long as you understand the costs.
Okay, so our takeaway for today was we should invest wisely with responsible and established financial institutions. We must be wise stewards with our resources.